Crypto trading doesn't fail beginners because they're stupid. It fails them because the entire system is designed to extract money from the inexperienced, efficiently, repeatedly, and without mercy. That's not opinion, that's structure. Let's break this down piece by piece, fact by fact. 1. Most beginners aren't trading, they're gambling with a UI. The first brutal truth, most beginners don't understand what trading even is. They think trading means buying something that looks strong, selling when it feels risky, copying what someone on X or YouTube just posted. That's not trading, that's emotional reaction inside a casino dressed as an app. Real trading is probability, risk management, expectancy, position sizing, execution discipline, and psychological control. Beginners skip all of that and jump straight to 20x leverage, market orders, no stop loss, no defined exit, no statistical edge. That's not bad luck, that's guaranteed failure by math. 2. Crypto markets are structurally hostile to retail traders. Crypto isn't the stock market, it's worse for beginners. Why? Because crypto has extreme volatility, low regulation, thin liquidity on many pairs, constant manipulation, no circuit breakers, 24/7 trading, no psychological reset. Large players, whales, market markers, funds see retail liquidity as fuel. Your stop loss, liquidity. Your liquidation price, liquidity. Your panic sale, liquidity. Price doesn't move randomly. It moves to where retail is positioned incorrectly, and beginners almost always position incorrectly. 3. Leverage is the silent killer. This alone wipes out most beginners. Crypto exchanges aggressively push leverage because liquidations are pure profit for them. Overtrading increases fees. Fast failure means fast deposits. Beginners think, if I'm right, I'll make more money faster. Reality, leverage magnifies being wrong. One mistake erases weeks of gains. A single wick can end your account. Fact, most retail traders who use leverage lose their entire account, not slowly but violently. This is statistically observable across exchanges. 4. Beginners trade noise, not structure. Beginners stare at 1-minute charts, 5-minute charts, indicators stacked with indicators. They think more indicators equals more confirmation. Wrong. Totally wrong. Indicators lag. They are derivatives of price. They do not predict, they react. Professionals focus on market structure, liquidity zones, order flow, risk and reward asymmetry. Beginners chase candles after they've already moved. By the time the beginner enters, the move is usually over. 5. No risk management equals inevitable ruin. This is non-negotiable. If you risk random amounts, change position size emotionally, move stop losses, add to losers, hold losers, and cut winners, you will lose, period. Even a trader with a 50 to 55% win rate can make money if risk is controlled. A beginner with a 70% win rate but bad risk management will still blow up. Most beginners never calculate risk per trade, maximum drawdown, expectancy, account survival rate. They trade outcomes, not probabilities. Markets punish that brutally. 6. Social media is a psychological weapon against beginners. This one is ugly. Crypto X, YouTube, Discords, Telegram groups, they exist to sell signals, sell courses, sell referrals, sell dreams. You are shown winning trades, not losses. Perfect entries, not failed attempts. Edited hindsight, not real-time decisions. This creates false expectations. Beginners think, if I just find the right strategy, I'll win consistently. Truth. Strategy is only a small part. Execution and psychology matter more. Most of the quote-unquote profitable traders online aren't profitable traders at all. Many make more money from content than trading. 7. Emotional damage compounds losses. Losses don't just hurt your balance, they damage your decision making. After losses, beginners revenge trade, increase size, abandon plans, trade out of boredom or anger. Crypto's speed amplifies this. There is no pause, no closing bell, no forced reflection. Mistakes stack fast. Psychology breaks before skill ever develops. 8. Beginners underestimate time and overestimate talent. Trading is a performance skill like surgery or aviation. No one would expect to watch a few videos, open a simulator, then operate on real humans. But beginners expect to do exactly that with markets. The reality is this: consistent profitability takes years, not weeks. Most quit before competence. Many never track data. Few ever review trades properly. They confuse confidence with competence. Markets exploit that ruthlessly. 9. Most beginners were never meant to trade. This is the harshest truth. Trading requires emotional neutrality, discipline under stress, long-term patience, comfort with uncertainty, acceptance of frequent losses. Most people psychologically are not wired for this, and that's okay. But crypto marketing tells everyone, anyone can do this. That is false. Anyone can try, almost everyone fails. Final truth. Crypto trading for beginners fails almost everyone because the market structure is predatory, the tools are dangerous, the education is misleading, the psychology is brutal, the expectations are false, the discipline required is rare. This isn't negativity, this is reality without filters. And reality doesn't care how motivated you are. It only respects preparation, restraint, and